The S&P 500 is one of the most widely followed stock market indexes in the world. It's a powerful tool that tracks the performance of 500 large-cap U.S. companies. These companies span various sectors and industries, providing a broad snapshot of the U.S. economy. Therefore, the S&P 500 is often used as a benchmark for the overall health of the U.S. stock market. But why is it so attractive to investors? Well, think of it this way. Investing in individual stocks can be a bit like putting all your eggs in one basket. If that company or sector doesn't perform well, your investment could take a hit. But by investing in the S&P 500, you're spreading your risk across 500 different companies. This diversification can help to buffer against the ups and downs of the market. Now, investing in the S&P 500 doesn't require buying shares in all 500 companies individually. That would be quite a chore. Instead, you can invest in the entire index through a single transaction by purchasing an exchange-traded fund, or ETF, that tracks the S&P 500. This is a simple, cost-effective way to gain exposure to the broad U.S. stock market. So whether you're looking to diversify your portfolio, minimize risk, or just get started with investing, the S&P 500 offers an attractive option. Many investors use the S&P 500 as a way to gain exposure to the U.S. stock market. So how do you invest in the S&P 500? One option is to buy an exchange-traded fund, or ETF. Now, you might be wondering, what's an ETF? Well, an ETF is a type of investment fund and exchange-traded product that is designed to track the performance of a specific index, sector, commodity, or asset. In this case, we're looking at ETFs that track the S&P 500 index. Imagine an ETF as a basket. This basket holds a variety of different assets, such as stocks, bonds, or commodities. When you buy a share of an ETF, you're essentially buying a tiny piece of everything in that basket. It's like buying a mini portfolio with a single transaction. Why would you want to do this? Well, there are several benefits to investing in an ETF over individual stocks. First off, it's incredibly simple. Rather than researching and buying shares in hundreds of different companies, you can just buy a single ETF that tracks the S&P 500. This gives you instant diversification, which can help reduce risk. Secondly, ETFs are flexible. They're traded on an exchange just like an individual stock. This means you can buy and sell shares in an ETF throughout the trading day at market prices. You can even use advanced trading strategies like short selling or buying on margin, if that's your thing. Thirdly, ETFs are often more cost-effective than buying individual stocks. ETFs typically have lower expense ratios than mutual funds, and buying a single ETF is usually cheaper than buying many individual stocks. This can save you a lot of money in fees over the long run. Finally, ETFs offer transparency. You can easily see what assets are held in an ETF, how it's performing, and what it costs. This information is updated daily, so you always know exactly what you're invested in. By buying an ETF, you can own a slice of the entire index with one transaction. It's a simple, flexible, cost-effective, and transparent way to gain exposure to the S&P 500. So, are you ready to dive into the world of ETFs? There are several ETFs that track the S&P 500, but two of the most popular ones are the Vanguard S&P 500 ETF, known as VOO, and the SPDR S&P 500 ETF Trust, or SPY. Both aim to mirror the performance of the S&P 500, holding the same stocks in the same proportions. However, there are some key differences between them that could sway your decision. First, let's talk about expense ratios. This is the annual fee that the ETF charges its shareholders, and it's expressed as a percentage of the fund's assets. Lower expense ratios mean lower costs for investors, and over time, these small savings can add up. VOO has an expense ratio of just 0.03%, while SPY's expense ratio is slightly higher at 0.09%. Next, we have trading volume. This is the number of shares that exchange hands on an average day. Higher trading volumes mean more liquidity, making it easier for investors to buy and sell shares without impacting the share price. SPY has a higher trading volume than VOO, making it a favorite among traders and institutional investors who value this liquidity. Finally, let's discuss dividend yield. This is the annual dividend payment that the ETF gives to its shareholders, divided by the share price. Both VOO and SPY pay quarterly dividends, reflecting the dividends paid by the underlying stocks in the index. As of the end of December 2023, VOO had a dividend yield of 1.32%, while SPY had a dividend yield of 1.28%. Now, what do these differences mean for you as an investor? Well, if you're a long-term investor looking to minimize costs and maximize returns, VOO might be the better choice. Its lower expense ratio and slightly higher dividend yield could result in higher returns over the long run. On the other hand, if you're a short-term trader or an institutional investor looking to take advantage of market movements and arbitrage opportunities, SPY might be more suitable. Its higher trading volume means more liquidity, making it easier to quickly buy and sell large quantities of shares. Both VOO and SPY are excellent choices for investing in the S&P 500. They offer similar performance, holdings, and sector allocations, and you can purchase them easily through most investment brokers. The main difference between them is in liquidity, trading costs, and fees. As always, make sure to do your own due diligence before deciding which one is right for you. Which ETF is better for you? The answer depends on your investment goals, time horizon, and trading style. Let's delve into how you can choose between VOO and SPY based on your individual circumstances. If you're a long-term investor seeking to minimize costs and maximize returns, you might find VOO to be a better fit. With its lower expense ratio, VOO can help keep more of your hard-earned money working for you. Additionally, VOO's slightly higher dividend yield could mean a touch more income for you over time. You see, every bit counts when you're in it for the long haul, and these seemingly small differences can add up over the years. On the other hand, if you're a short-term trader or an institutional investor, you might lean towards SPY. With its much higher trading volume, SPY offers more liquidity. This means that it's generally easier to buy and sell shares without impacting the price too much. If you're looking to move in and out of positions quickly or take advantage of arbitrage opportunities, the liquidity offered by SPY could be a significant advantage. But don't forget, both VOO and SPY are excellent vehicles to gain exposure to the S&P 500. They offer similar performance, holdings, and sector allocations. They're widely available and easy to buy and sell through most brokerage accounts. It's not so much a question of good or bad, but rather which one is a better fit for your unique needs and strategies. Remember, whether you lean towards VOO or SPY, it's crucial to consider your own investment objectives and risk tolerance. Each investor's situation is unique, and what works for one person may not work for another. So be sure to do your own research, consider your personal circumstances, and perhaps consult with a financial advisor before making a decision. Investing in the stock market always carries risk, but with careful planning and informed decision-making, you can position yourself for potential success. As always, you should do your own due diligence before choosing one over the other. Thanks for watching, and as always, happy investing!